Hi everyone, welcome. I'm Diajeng Aulya Sekartaji, MBA student of IPMI International Business School, and in this video we're going to explore the fascinating world of corporate finance. This course is facilitated and taught by Professor Roy Sembel. There will be 7 chapters that we will study as seen on the screen, so let's start now. Our first chapter is financial management. But what exactly is the objective of financial management? It revolves around basic, operational, social, and research objective. These guide us in managing capital structure, working capital, asset structure, cash, and even risk. Let's dive into the core of financial management. Now, within corporate finance, we uphold the 4 cornerstones, the principles that guide us steadfastly. They are known as the core of value principle, conservation of value principle, expectation treadmill principle, and best owner principle. However, the principal agent problem often arises, creating a conflict of interest between owners and manager. The solution? Effective performance evaluation, proper incentives and penalties, and addressing information asymmetry. Entering the GCG with its tariff principles, transparency. Moving on, the 5 business essentials by Professor Ramcharan. There are cash, profit margin, velocity, growth, and customer focus. These principles serve as our guiding lights in navigating the corporate finance landscape. In our second chapter, we're delving into a fundamental concept that shapes the financial landscape, the time value of money. It's the principle that asserts a sum of money is more valuable now than the sum in the future. Why? Because money can... Imagine this scenario. You over 10,000 today or 10,000 2 years from now. Despite the equal face value, 10,000 today holds more value and utility due to the opportunity cost associated with the delay. Now let me introduce you to a handy tool in the financial toolkit, the rule of 72. This formula is a quick and useful way to estimate the number of years required to double an investment at a given annual rate of return. It can also work in reverse, helping you compute the annual rate of compounded return from investment based on how many years it takes to double. Next are the crucial planning process for long-term investment. Capital budgeting, the strategic planning process for investing in long-term assets. And when it comes to making this investment decision, we have several methods at our disposal. We consider methods such as net present value, internal rate of return, profitability index, and payback period. However, among these, the one that takes the spotlight first is the net present value or NPV. Why? Because net present value is the cornerstone, the starting point in our evaluation process. It's considered more conservative as it takes into account all cash flows, discounting them using a realistic rate. This method allows us to predict the value of future investment from their current value. Next one is analysis of security. An investment strategy is a systematic approach to making investment decision based on principle guidelines. It involves selecting a portfolio of investment expected to meet the investor financial goals while considering their risk tolerance, time horizon, and investment objectives. From investment strategy, we're moving on to fundamental analysis. It's a valuation tool used to determine whether a stock is over or undervalued by the market. It considers the economy, market, industry, and sector condition a company operates in and its financial performance, which attempts to forecast price direction through analyzing historical market data such as price and volume. A DuPont analysis is used to evaluate the component parts of a company's return of investment. A DuPont analysis is used to evaluate the component parts of a company's ROE. DuPont analysis breaks ROE into its constituent components to determine which of these factors are most responsible for changes in ROE. Lastly, the technical analysis. This analysis may be contrasted with fundamental analysis, which focus on a company financial rather than historical price patterns or stock trends. Technical analysts believe past trading activity and price changes of a security can be valuable indicators of the security future price movements. We've also learned about capital structure, that is the particular combination of debt and equity used by a company to finance its overall operation and growth. The Capital Asset Pricing Model, or CAPM, is a model that describes the relationship between the expected return and risk on investing in a security. It shows that the expected return on a security is equal to the risk-free return plus a risk premium. Weighted average cost of capital, or WACC, represent a company's average after-tax cost of capital from all sources, including common stock, preferred stock, bonds, and other forms of debt. As such, WACC is the average rate that a company expects to pay to finance its business. Beta is measure of the volatility or systematic risk of a security or portfolio compared to the market as a whole. Beta is used in capital asset pricing model, which describe the relationship between systematic risk and expected return for asset. The required rate of return is a key concept in equity valuation and corporate finance. It's a difficult metric to pinpoint due to the different investment goals and risk tolerance of individual investors and companies. Imagine a business that facing challenges like a ship sailing through rough waters. The first step in corporate restructuring is to stop the bleeding. It's like putting a band-aid on the wounds, addressing urgent issue to stabilize the ship. Now think of financial restructuring as the ship's renovation. Maybe renegotiating debts or optimizing expenses to make sure the ship's resources are used wisely. Then we get into strategic realigning. It's like the ship adjusting its sail for optimal wind direction. Businesses redefine their game plan to adapt to the ever-changing business winds. When a business is really in the thick of it, they might consider redefining their core business. It is like deciding to become a sleeker, faster ship by focusing on what they do best. And finally, we have looking for new ways of doing business. Businesses innovate and explore fresh approaches to stay ahead in the game. Fraud shenanigans are basically sneaky. It's like a secret game of deception where folks cook the books, fake documents, or manipulate info to make things look way better than they actually are. It's the kind of stuff that gives you trust issue in the financial world. The fraud triangle is like a cheat code for understanding why some people go all sneaky in the world of finance. First off, you got pressure. That's when someone feeling the heat, like debts piling up or life getting crazy expensive. Then there's opportunity, the chance to pull a fast one without getting caught. Lastly, you've got motivation, so it's like a recipe for trouble. Mix pressure, opportunity, and motivation, and you've got a classic case of someone thinking, why not bend the rules a bit? It is the kind of triangle you definitely don't want to find yourself caught up in. Occupational fraud refers to deceptive activities carried out by individuals within an organization for personal gain. It involves employees exploiting their position to commit fraud, often through schemes such as embezzlement, corruption, or financial statement manipulation. A dividend is a share of profits and retained earnings that a company pays out to its shareholders and owners. When a company generates a profit and accumulates retained earnings, those earnings can be either reinvested in the business or paid out to shareholders as a dividend. Why companies should pay dividend? Companies should pay dividends for several reasons. Firstly, dividends act as a significant signal of real profit to investor. When a company distributes dividends, it demonstrates financial stability and confidence in its ongoing profitability, which can attract and reassure shareholders. Secondly, dividends can be more tax efficient for investors compared to earnings from stock returns. Depending on the investor tax situation, dividends may be subject to lower tax rates than capital gains, making them an attractive form of income. Additionally, distributing dividends can help prevent the accumulation of excessive free cash flows, promoting efficient capital allocation, and potentially enhancing shareholder value through strategic investment or share buybacks. Thank you for joining me on this insightful corporate finance mind mapping. Hopefully this video sparked new ideas and strategy for you. Stay tuned for more content, and until next time, thank you!